welcome. You are watching Property Hotline with me, Kavita Krishnan. Significant announcements on the tax front by the Finance Minister in the Union Budget. SOPs on long-term capital gains, but also a 2 lakh rupees cap on the interest deduction on your second home loan, apart from the TDS that you'll now have to pay on rent if you are paying rent of more than 50,000 rupees per month. How will all of this impact your real estate transactions? That's what our expert today will break down for us. With me here in the studio is Jayesh Karia. Jayesh is a partner at BSR Associates. Welcome to the show, Jayesh.
Hi, good evening, everyone. Good evening, Kavita, to you as well.
Right, Jayesh, let's start by breaking down what has been really announced in the Union Budget. Now, we know that there is, of course, the first one, of course, is a long-term capital gains, which, of course, should bring a lot of cheer to home buyers and investors over there. 2 years, that's all that you have to hold a property now if you want to sell and exit. What does it mean?
Yes, Kavita, your understanding is right. Earlier, we had a 3-year period for the holding to claim the long-term capital gains tax benefit of 20%. But now, after a lot of representations that for the shares and the other equity instruments, the period has been reduced down to 24 months for the property that was not being done. And this time, the finance minister appreciated the, I would say, representations made by the common man, and has, I think, given that benefit for the sale of the land, building, or either of, or both of together to say it as an immovable property, and the capital benefit, capital gains tax benefit is available if the asset is held for 24 months instead of 36 months.
And the 24 months from the date of possession of the property, right?
Yes, there is a, I think, I don't want to get into that controversy because there is a kind of a controversy around it. People take a position that, shall I take it from the date of the allotment of the property, or shall I take it from the date of the possession? Now, there are judicial rulings which actually talk about from the date of the possession. And in my personal view, I think it has to be from the date of the possession. And if one want to take an argument that this is from the date of the allotment, then I think one need to, get into a different line of argument and say that the allotment letter gives me a right, and that right itself is a kind of an asset. And I've been holding that asset for a period of 2 years or 3 years. So 2 years will not, 3 years. And now with the last year amendment, it will be 2 years. And then say that the gain that I'm getting is not on account of the sale of the property, but the sale of the interest in the property, and therefore there is a long-term capital gains tax. Right. But then the whole, I would say, the application of section would go from section 54 to 54F, and then the whole, I would say, the mechanism for claiming the deduction for further investments would be governed by different section and not by Code 54 of the Income Tax Act.
Right, so that is of course a positive for somebody who wants to invest in real estate. Though on this channel, like we've always been advising you, real estate is not a short-term investment. It's not that kind of an asset class. Ideally, you should be investing in real estate for the long term, at least for 5 to 7 years, so that you can get maximum benefit out of that particular asset. Also, the other change, of course, as far as long-term capital gains is concerned, is the fact that the date of calculation has now been changed of gains. I believe has been changed from 1981 to 2001. That is the base year now from which you have to calculate long-term capital gains.
Yes, Kavita, there also you're right. In fact, that's a very big incentive which has been provided by the finance minister this year by moving the needle or the base year from 1981.
How will that benefit an investor?
See, like take an example that your indexation for 1981 is 400, whereas for 2001 the indexation is almost about, say, 320. So what will happen that if your cost of the property, if you would have bought prior to 1/4/1981, and that cost of the property would have been 1 lakh, assuming that you don't know the cost, and if the cost is, say, 60,000, still you were entitled to take the cost of 1 lakh based on that 100. And now what is happening that since the year has been shifted to 1/4/2001, and if the index is 320, then your cost step up, or the cost steps up, and you get the cost deduction of 3,20,000 rupees instead of 1 lakh, and if you have sold the property for say 5 lakhs, then your capital gain, which otherwise would have been 4 lakhs, that gets truncated to 1,80,000 rupees. So there is a significant, I would say, the benefit or kind of a step-up cost which is available by virtue of these, I would say, the shifting of the base year from 1/4/1981 to 1/4/2001. So this is again a very big incentive for the, I would say, the investors and the property owners kind of. So this will stimulate the, I would say, the market, both the, I would say,
so two really positive steps there for investors. And staying with capital gains, we have a question that Vimalesh has sent in, and he wants to know, Jayesh, what is the liability to pay capital gain tax for joint development agreements? I am not able to understand the announcement that was made in the budget on February the 1st. Can you explain in detail? This is, of course, a change that has come in, and there's something that landowners need to pay attention to. Jayesh?
Yes, Vimalesh, I believe you must be the landowner, because this amendment has been, I would say, brought for the benefit of the individuals and HUF who are owning the land. Up till now, I think there was a lot of controversy with regard to taxation of the joint development arrangement, whereby the landowner was, I would say, arguing that income is not taxable till he receives either the revenue share or he till receives the area share from the developer in terms of the joint development agreement or the arrangement. But the revenue authorities have been taking a position, depending on the factual aspects in the documentation, to say that the capital gain arises the day when the joint development agreement is entered into, and then the general power of attorney is being granted by the landowner. But now with this, I think this controversy has been set at rest by the finance minister to say that if you are an individual and HUF, and if you have entered into a joint development arrangement, and specifically it talks about the area share arrangement and not a revenue share, you might have some revenue share or some remuneration which is in the form of a cash, but largely it is an area share. And if you receive an area share after the project is complete, then your tax liability will get shifted from to the date of your receiving your share in the property. And what it says that when you receive your share of property from the developer, then the market or the stamp duty valuation of that property on the date of the receipt will be regarded as your sale consideration, and then you reduce your original cost of the land, so that will be your capital gain. And since you would have been holding for a period of more than 24 months, so that will be a long-term capital gains tax, and you can claim what you call it as a capital gains tax exemption of that. And when you receive that property and you sell that property, what it says that the stamp duty valuation which has been taken for considering capital gains taxation at that point in time becomes your cost when you sell your property, and accordingly the capital gain would need to be computed. And it also says that if the developer pays you some additional amount of money over and above the area share, then that also would be regarded, would be considered as a consideration. But then the developer will have to withhold tax at the rate of 10% when he's going to make the payment to you as a landowner. So this is again a good news. I think it is clarifying the position, and therefore there is a benefit. The law also says that if you have a share in that area share, and if you kind of exit before you want to receive your kind of property, in that case you will not be able to claim this benefit. You will be subjected to normal capital gains tax, so therefore this benefit will not be available.
Okay, I was just about to ask you.
When you exit in between, then there is no benefit.
What happens to this is of course for individuals, individual landowners. Right. We know that a lot of housing societies, especially in cities like Mumbai, are going in for redevelopment.
Right.
Some of them own the land, own the building, and they want their old building to be redeveloped, and they are also asking for a new tower to be built.
Right.
They might enter into joint development agreements.
Right.
Does this apply to the society as well?
See, the society is not an individual, nor a kind of what you call it as HUF. It is actually being regarded under the Income Tax Act as a body of individuals. So therefore, I suspect that this benefit would be available to body of individuals. But the arrangement that you're talking about for the society, there the tax consequences are a little bit different than what you call it as a pure transaction of the landowner entering into an agreement with what you call it as the developer. So the I would say the ramifications are a little bit different, and it can take about 15-20 minutes for me to explain.
Right. So essentially what you need to remember over here is that the law has changed as far as landowners are concerned who are going into joint development agreements. Capital gains, the exemption has to only be realized at the end when you actually get possession of the project, right?
Absolutely.
That in very simple terms, that's what it means. And as far as societies are concerned, the rules, of course, would differ. And like Jayesh said, it is a little complex and it does make a lot of sense, especially in light of all the changes that have been announced in the budget, to go to a tax consultant before you sign on those agreements with developers. Let's take Simran's question now. She says she wants to know if we could elaborate on the income tax exemption for affordable housing. What is to be considered as carpet area and what is to be considered as built-up area? Income tax exemption for affordable housing, that was not really announced in the budget, right?
No, there is an announcement in the budget. In the last year, in fact, the concession or the tax
benefit. The last year's budget, not this year's.
The last year's budget, there was a concession which was given to the developer who are developing the affordable housing. And the period, it provides for the 100% exemptions of the profit from the development of the affordable housing. But there were, I would say, the certain conditions which were a bit more onerous for the developer. And now some of the conditions have been relaxed to say that the affordable housing scheme would be available in a metro cities if the area or the house which is being developed is 30,000 square meter of built-up area or 60,000 square meter outside the metro limits. And it also talked about 25 kilometers within the municipal limit is also a kind of subjected to 30 square meter area. Now this year budget, the finance minister has relaxed that conditions and said that instead of built-up area, it should be a carpet area. So effectively what has happened that 30 square meter has become 40 square meter. So the house size will increase as far as the metro cities are concerned. And that the condition of 25 kilometer, the coverage of 25 kilometer from the municipal limit also has been done away with. So therefore, for an example, in the earlier budget or the present act, Thane would have been covered under the earlier regime and 30 square meter, I would say the condition would have been applied. But now with this amendment, Thane would have a 60 square meter of the carpet area, again not a built-up area. So almost about 1,000 square feet of a built-up area or more than that would also be regarded as affordable housing, and the developer would be able to kind of come out with the affordable housing scheme in the areas of Thane, Dombivli, Kalyan and those areas, and will be able to claim tax exemption in respect of those projects. So this is the, I would say, the benefit that has been granted by this.
Essentially,
and
this
the
is
second point,
that,
let me just complete. The second point, earlier one of the onerous condition was that the affordable housing project should be completed within a period of 3 years. So that has been extended to 5 years. So this gives a good amount of time for the developer to complete, given the kind of, I would say, the uncertainties around the approvals and the kind of material non-availability and so on and so forth, which are beyond the control of the developers. So there is again a good, I would say, the move, which is going to, I would say, create a good sentiment for the developer and for the house buyers, because they will be able to get more stocks. They will be able to see more stocks on the affordable housing front. And let's see on terms of the pricing. And I firmly believe that the pricing will, I think, will have its own softened down, depending on how the kind of cost moves and how the GST tax rates comes in place.
It should, no, because if they're saying affordable housing, and the good thing here for the home buyers, of course, is the change in the definition, the fact that it has been linked to carpet area and the size of the flat. So you're essentially getting 300 odd square feet homes or 600 odd square feet homes. That's what 30 square meters and 60 square meters essentially translates into in cities or in the outer limits of cities. That is what the government has really announced, and there are really no tax exemptions that you are getting as a home buyer. However, there are exemptions being given to the developer, and the hope is that the developer will then pass it on to the home buyer. What we are hearing from industry is this should ideally, this should work as an incentive for industry for them to go ahead and build more of those smaller homes which are easier on the pocket, and hopefully you will also see, like Jayesh said, you will also see some of those prices easing, homes actually coming within your reach. But that is, of course, something that we'll need to wait and watch for. A question from Puneet Kinariwala. He wants us to explain tax on vacant house for 1 year after completion certificate. Does it mean that developers will be taxed if they have unsold inventory for more than 1 year after receipt of the completion certificate? Will this compel builders to cut prices and sell property within 1 year of receipt of completion certificate? You know, we'll talk about how home buyers have been hit a little after this. But Jayesh, the fact is the middle class is feeling very, very left out of the budget. And from the looks of the questions that we are getting, they're trying to clutch at these straws that the finance minister essentially tossed. And they're hoping that it will benefit them. What do you say?
See, I would say that this is, I would say again, in a sense that people should not take it as a kind of what you call as a high expectation point of proposal kind of, because see, there was a controversy around this, Kavita, to say that when the developer has a stock which is available for sale and it has not been sold, so the revenue has been taking a position that it is deemed to have been lot out. And therefore, the notional annual rental which it would fetch otherwise would be a kind of income from house property, and then certain deductions would be available and taxable, even though it has not been let out. So, which is a similar provision for a second home owner where he is not able to let it out. Now, here what in a sense, it is like can be interpreted in two ways. Earlier, there was no provision for taxing this kind of stock in trade which is available with a developer. But now what has happened that formally now the law has been introduced to say that this will be taxed in the hands of the developer. But the concession has been given that up till first year there won't be any taxation. So coming back to your point, that will that kind of create a pressure on the developer to sell? To my mind, I would say not the pressure, but certainly the developer would plan to see to it that they will be able to sell most of the houses before the project is completed, because it talks about 1 year from the date of the completion of the project. So they will definitely try. But again, one has to see the what you call it as the market dynamics, market realities. And I think the developer are not worried about this. If there is no market, if they were to hold it, then I don't think that they would be worried about the taxation on this. Yes, it is not the kind of a right proposition, and it has not been kind of say taken with a good taste. But I think with the kind of incentives which have been made available in this year's budget to the sector, I think this is a small, I would say, pinch in the salt which they are going to take.
And this essentially, yeah, is one of the costs of doing business for the developer also.
It's a cost of doing
they will hold it till...
Absolutely, absolutely. So that doesn't mean that the developer will start selling their properties at a kind of a 20%, 30% lower price to get away with this taxation, because this is not going to be a significant tax for them, and they will, I think, hold back if they are not going to get the right price.
Right. So Puneet, you're not really going to see prices come down because of that particular announcement by the finance minister. In fact, it was an announcement that was actually pro-industry. And something that the industry has been lobbying for quite some time. But, I know Ravi is on the line with us from Delhi, and he has a question. Ravi, I request you to hold on a little, because there is something very important that I need to ask you, Jayesh.
Sure.
And you spoke about notional gains from unoccupied property, the deemed let out. Now, we know that when home buyers, and this is when you buy a second home, and when you lease out property, there is technically no ceiling on the income tax, on the deduction that you can claim on interest tax, on interest. But even that has been capped in this year's budget. It is part of the amendments that have been brought in really to the finance bill. How is that really going to impact the home buyer? Does it really make any sense now to buy a second home from the tax perspective?
Yes, certainly, Kavita, you're right that earlier for a second home buyer, there was no limit on the allowability of deduction of interest which he used to pay on the funds borrowed for buying that second home. Now, what was the thinking behind the regulators to bring in this kind of limit is that this was being, I would say, used as a kind of what you call it as a mischief. And people used to borrow money and then invest and then claim this deduction against various other income, and at the same time enjoying the benefit of appreciation and selling the flat at a much higher price, and they're also claiming the deduction by reinvesting, either claim as a long-term capital gains tax benefit or reinvest into other property and buy. So therefore, there was a kind of upside which was available. And if you look at the budget, the focus is more on giving benefits to the home buyers and also a benefit to the developer to construct affordable housing, and not to kind of incentivize the investors community in that sense. And plus also to plug this mischief rule, this, I would say, the amendment has been introduced, which provides that if you are a home buyer and having a second home, and if you have let out that property, and if you have borrowed money, then your interest deduction would be restricted to 2 lakhs, which is similar to like interest deduction up to 2 lakhs for a self-occupied property. So it has been made at par. But one good thing, it has been kind of brought that the balance or the excess interest can be carried forward as what you call it as the loss, and which can be set off against your income from house property and not from any other income. So this is, to my mind, that this is a, I would say, some mischief rule. Will it kind of, to your question, that will it disincentivize the investor to kind of invest into a second home? My answer would be no. It depends on the situation to situation, because real estate today is still a very good asset class as compared to other investments, given that the rate of interest which is going down on the fixed deposits, bank fixed deposit rates are going down. Overall rates are also, lending rates are going down. So if you look at the investments, the tax-free investments which the investor will enjoy due to the exemption under Section 54, I think still one can have what you call it as 12 to 15% tax-free return. And then in lieu of that, if there is a foregoing the additional interest claim, then I think still it will offset kind of. So it all depends on, I would say, the situation to situation, and one cannot generalize that the people will not go for a second home buying, or people will not now invest in real estate.
But the fact of the matter is, if you
yes,
had bought that home,
as an investor, yes, it is a loss, and it is a kind of,
a loss
my
that
IRR will go down if I look at my kind of IRR on the investment proposition. So I'll keep that in mind, and to that extent, yes, it will impact.
It does make, as an asset class, it does make real estate a little less attractive. But the fact is this: if you are buying that second home and you are hoping that you've taken a home loan and you will be able to offset more of your income tax, you will be able to claim more deduction. That is not going to be possible in the new financial year. You will only be able to claim up to 2 lakh rupees as exemption. That's it. That has been capped according to the budget that was presented on February 1st. Ravi is on the line.
I wish, just before we move on to the next point, I wish the finance minister should have increased the limit for interest deduction for the first home.
I was just about coming to that.
That in fact, that's what 5 lakhs. Because that's the, I think today
that was the most popular demand. That's what everybody was asking for.
And
but
really that would have helped the, I would say, the home buyers.
But sadly, what has happened is he's taken away the deduction. He's reduced the deduction that you were getting for the second home, and he's not really given you any benefits for the first home buyer. We have Ravi who's called in from Delhi. Ravi, thank you for holding the line. Tell us what's your question.
I just wanted a small clarification that the benefit in the capital gains on sale of a house has been given by extending the base year from 81 to 2001. But at the same time, the finance minister has imposed a surcharge on income exceeding 50 lakhs. So he's given with one hand and taken it away with the other. What's the view of the panel?
He's given with one hand and taken away from with the other, and that is essentially what the middle class is feeling. What do you say, Jayesh?
No, Ravi, your point is right that yes, but if you look at, as I explained in the example of 1 lakh versus 3,20,000, so the benefit is certainly significant. And as I said that the budget is, I think, trying to support or trying to kind of fulfill the wishes of the middle class, and maybe above between 10 lakhs to 50 lakhs is not something, 50 lakhs to 1 crore is not a middle class, maybe an upper middle class or super middle class kind of thing, where he believes that the benefit should not have been given. And that's, I would say, that bracket, I think, almost about what you call it as about 1 crore of the taxpayers, as per his speech, will get impacted. So this, I would say, is a bit, I would say, the harsh proposition, and I would say that The strategy, to my mind, I look at it as like a Robin Hood strategy, is you just take away from the people who are rich and distribute it to the poor, kind of. So that's the approach. To me, it looks like from the finance minister's, I would say, the proposals. And certainly, yes, because I'm also falling in the same brackets. I'm also having the same
but I like the way you put
as
it,
you are having, Ravi.
I like the way you put it, Robin Hood strategy. But the fact is, the one big thing, that the one reason why middle class used to invest in real estate, that really is gone. You're not getting that exemption that you were getting, the limitless exemption that you were getting on the interest that you paid on your second home loan. That, of course, has been capped at 2 lakh rupees, and that is one of the biggest negatives as far as this budget is concerned. Sanjay sends a question through email.
Just my last, I think, to all the investors or the viewers, that please look at it positively, that the glass is half full and not half empty, because one cannot fulfill everybody's wish or all the wishes, because there are certain constraints, and whatever that has been done, I think that has been done to the best of the
you can't fulfill everybody's aspirations, that is true, but
yeah, I wish somebody could have been done. As I said, yes, something more should have been done, but let's see, this is a good direction if that happens in the next year.
Right. Very quickly, we are completely out of time. The TDS on rents,
right,
that you need to pay on rents over 50,000 rupees, 5% TDS.
Right.
Now, typically TDS, when you pay it on the sale of properties, on the purchase of properties, you pay it as part of the overall value. What happens when it is charged on rent? Will it be part of the rent that you're paying? So 5% of, say, the 50,000 that I'm paying, that will be included in the rent, or will it be charged separately?
See, this is the kind of a withholding tax provision. Like, take an example, a company takes a property on a rental and pays a rent in excess of the threshold limit, then the company is required to do the withholding at the rate of 10% under 194I of the Act. Now, since what is happening, that the government is seeing that we are looking at the kind of
Jayesh, make it very simple for me. What I want to know is this. Is it now when I go out to take a flat on rent,
right,
what happens? Is it 5% plus 50,000? Is that going to be my rent?
No.
Or will it be 5%, 50% minus,
like if
5% minus 50,000?
If you are kind of taking house on rent, and if the rent is more than 50,000 rupees per month, like take an example, 60,000 rupees. So when you pay to your landlord 60,000 rupees, you deduct 5% out of that as a tax deduction at source, which is 3,000. So you'll pay 57,000 rupees to the landowner, and 3,000 rupees you will deposit to the government as a tax paid on behalf of the landlord. Like we have 194IA, when you make a payment of installment to the builder for purchase of a property at the rate of 1%, same procedure would need to be followed as far as this provision.
And you need to pay the TDS in order to be able to claim HRA?
Yes, of course.
Right. Okay, so essentially that is the other big announcement that came in the budget, and that's one that you need to look out for. With that, of course, we come to an end of this episode of Property Hotline. But any questions related to any announcements that have been made in the budget or related to real estate, do send them in and we'll make sure that all your questions are answered. Thank you for watching.
Thank you, Kariya.
You can watch live TV on our website mbnow.in. Find us on Facebook at facebook.com/Magicbricks Now. And don't forget to click the like button. You can also follow us on Twitter at Magicbricks Now. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/Magicbricks Now.